Hi class. Today we're going to be going over lesson number 2 of Unit 3, Small and Big Business. So today we want to look at our homework first as usual, and so make sure that you have a good understanding of our lesson 1. And so the first question and the third question kind of talk about potentially what types of businesses these may be: barbershops, pig farms, gold mines, etc., etc. And question number 3 talks about diversification, so you want to make sure that you understand these concepts before going on. On the next page, or next set of questions, talks about what business structures that you might want with a firm: law firms, convenience stores, loan organizations, etc., etc. So make sure you understand those answers as well. Number 2 talks about the differences between components of the business structures. So general partners versus limited partners. It's very important to understand the difference between these two types of partners and why they are different in terms of liability and decision-making ability. Second part of this question asks about corporations, public versus private. We'll talk a little bit more about those today in terms of stocks, and then as well as dividends and profits versus patronage regarding corporations and cooperative enterprises. So that's number 2. And then number 3, you can refer to the reproducible sheet that I'll post as well to get the answers to those questions. So for today's lesson on small and big business, our learning goals are to know how to grow businesses, be able to evaluate different methods of growing businesses and making financial decisions, understanding the value of large and small businesses and methods to grow, and how the security markets will work. And so today in this class, we'll look at how you interact with the material as well as each other. We'll start a stock market game, and then we will also obviously do the review of homework. So, small and big business. So if we look at small and big businesses, we look at small business first. And so we say, what is a small business? A small business typically is limited in size and scope of their operations. They face competition from many, many small firms. These small businesses typically or tend to innovate, try to get better quality, try to offer better services. They need to be more aggressive, oftentimes can be niche in terms of what they offer. They'll specialize more. They might have to spend more on small market marketing and stuff like that. And oftentimes businesses that are small are typically defined between having 5 to 100 employees. And so if you have larger than that, but less than maybe 500 employees, you might be considered a medium-sized business. Or if you have less than 5 employees, you're a micro-sized business, or almost like an individual working on something. And so why do we bring up small business? We want to talk about small business in terms of the scope of our economy, and we talk about perfect competition and how we want many, many small businesses to operate that offer similar types of products to enforce a competitive marketplace. But we all know that small businesses, as they grow, as they make more money, as they try to innovate and to become better, they're ultimately going to start growing larger, right? Going into medium-sized businesses, going into big businesses. And so we're going to look at that transition from small business to big business, and maybe how it works, why we may want to do it, and what's the best way perhaps to do it depending on which situation you're in. So how do we go from small to big? Oftentimes we look at horizontal integration. We'll look at vertical integration, and we'll look at organic growth. So briefly, I'll talk about organic growth first, because we'll talk more in-depthly on horizontal and vertical integration. So when you go from a small business to a medium-sized business to a large business, the small business is going to make money, have workers, sell product, and eventually it's possible that the small business can use their profits to, open up a second shop, or go into a bigger facility, or grow to build a factory, or invest in some capital. And so they're going to use the profits from their own company to slowly grow a little bit by a little bit by a little bit, right? And so this process often will take an enormous amount of time. And so to finance the growth of their business, every year they have to make a little bit more money to put back into the business, or they might have to take bigger amounts of debt to just buy outright a new factory or something like that. And so this type of organic growth takes time, but it allows you to keep control and power within your business. And so it all depends on what your timelines are, what your goals are in terms of a small business owner, what speed you want to grow, how much control you want of your business, etc., etc. And so when you think of things like Dragon's Den, These businesses will go into Dragon's Den or Shark Tank, and they'll pitch their ideas, and they'll say, we need some money. Would you like some equity from the dragons, right? And so this is a method that they're trying to sell equity in their business to grow faster, versus they could have just taken time and grown it slower, right? And so organic growth is one method to go from small to big business, but organic growth is only part of the story, because the other forms, horizontal and vertical integration, are methods to speed up that process. And we're going to take a look at what those are right now. Horizontal integration. Horizontal integration talks about the purchase and control or merger with a similar type of firm that offers similar products or services. And so, what are we talking about? We're talking about the ability for one firm to merge or buy another firm, and that will give them cost savings, right? That will allow them to get rid of some types of costs. That will allow them to consolidate departments and do several things. They'll share the resources of each other, right? They might work in different marketplaces. They might have different geographies. They might have different expertise in different types of things, even though they sell the same type of thing, but they can share resources and expertise. They will achieve economies of scale. These two businesses that were separate now are one business, and they can produce faster, they can specialize, they can do many things. Remember our previous conversations when we talked about farmers with neighboring farmlands, right? Separately they can work, separately they can operate, but if they start to join together and create a firm structure, they're going to get faster, they're going to become more profitable, they're going to become more efficient. And these are methods to potentially get your business larger. And one example of this could be Best Buy and Future Shop. This example didn't age very well as Future Shop is now gone, but back in the day, Future Shop was a Canadian firm that was in Canada operating, and Best Buy was in the United States. And so Best Buy could have just tried to get into Canada and operate and compete against Future Shop, but actually they bought Future Shop. That was one entryway into Canada, and they opened up their own stores. And obviously, you see what's happened now. Best Buy exists, but Future Shop is now gone, because they basically did the same thing. And when you would see a Best Buy across the street from a Future Shop, you'd go to the Future Shop, you'd go to the Best Buy, and think, oh, I'm going to compare prices. But in actuality, they were the same firm. They were the same company. And that's one example of horizontal integration, right? So Best Buy bought Future Shop, bought a whole bunch of customers, got into a geography in Canada, right? They could cost save by maybe having one shipping truck, by having one human resources or whatnot. They can share their resources, right? They have different suppliers, but now they can share suppliers. They can consolidate suppliers. They have economies of scale, right? They can do things better, faster, because they do basically the same type of thing, right? So they are going to have horizontal integration, and the firm will become bigger. Another example, which you might be more familiar with, is that Disney bought Pixar. Disney, they own amusement parks, they make movies, animated movies, they sell merchandise. Pixar was an animation firm that makes also animated movies, and so this is a horizontal integration because Pixar does what Disney does, okay? And so Disney bought Pixar for $7.4 billion. And so what are they doing? They are just consolidating this animation of movies industry into one firm, right? Although Disney does more things, Pixar does part of what Disney did, right? So they're taking away competition, and they're consolidating customers, and they're buying expertise, they're buying technology, they're buying all these types of things, right? So this is an example of a horizontal integration to make firms bigger, right? Disney bought Pixar for $7.4 billion, but by enveloping Pixar into the company becomes bigger, right? And so they're growing the size of their firm, even though Disney was already humongous. So in summary, horizontal integration is about another firm or two firms merging or becoming one firm when they had similar characteristics or similar skill sets or similar products. Okay, much more easy to understand for horizontal integration versus vertical integration. Vertical integration is a little bit different. It's a bit more varied. So that the vertical integration talks about diversifying scope and or extending operations through acquisition or merger. So what does this mean exactly? So one method is to control vertical inputs, increase the quality and quantity of your product. And so you could have one firm that, for example, I'll just make some information up. You could have a firm like IKEA or a furniture company, right? So they could make furniture potentially. But what would they have to do to make furniture? They need to get lumber, or they need to get wood, or natural resources, or product, right? So potentially one of these firms could buy a lumber yard or a wood processing mill, so that they can control the product, the quality of the product that they get for their stuff, and they can control how much they do get of it. And they can understand that if the price of lumber goes up, their costs of production aren't going to be significantly changed because they own the lumber mill that gets the lumber, right? So they can control the vertical inputs of what happens in their firm. And so that's one way to grow the size of your operations, diversify your scope by vertically integrating the factors of your production and your logistics chain. Another method is just pure diversification. One firm buying into another to just do something totally different, right? You're just diversifying what you do. So this is not about controlling your inputs or controlling the logistics chain or whatnot. You're just doing something different, and you're just doing something to produce a different type of thing, so that you are going to get two markets. So if one market totally collapses, you have another market to fall back on. And so let's look at a couple examples. So one example from my time is Rogers. Rogers, as maybe some of you know, owns the Toronto Blue Jays. Rogers is a telecom company, so the Toronto Blue Jays is a sports team. What does this have to do with Rogers, right? Rogers, they do lots of things in the telecom space. They also own the Sky Dome. The Sky Dome, as I know it, is now called the Rogers Center, right? There's marketing there, but they own the place where the Blue Jays play, and so they own some of the inputs. And the Blue Jays are an entertainment sporting team which gets played on Rogers networks, and so they own some of that vertical input as well. But they're totally different products. They're entertainment systems as well. But you can understand how they're not the same type of company, right? So the Rogers, Skydome, Blue Jays, it's very vertically integrated versus horizontally integrated. And another example would be Amazon or Whole Foods. So Amazon bought Whole Foods several years ago for $13.7 billion. Amazon is not a supermarket grocery store company. Amazon is an online logistics delivery retailer. Whole Foods is a in-person store that sells food. So why would Amazon do this? Amazon likely believes that they can enter this space and do different things. There are some Amazon Whole Foods locations that have no retail checkout people, that you just walk in and do not food service, but do grocery without having to interact with people. Amazon is the online technology, one of the leaders, and so maybe they believe that they can use some of their skill sets into grocery store, Whole Foods types of things, right? And so again, and we also want to think about who are their customers here. Amazon and Whole Foods, lots of people use Amazon. Whole Foods customers are more specific, but lots of Whole Foods customers, I guarantee you, are Amazon Prime holders and use Amazon a great deal. And so there is going to be an overlap, a vertical integration, a diversification of these two companies, which is one of the reasons why Amazon probably bought Whole Foods. And so now we've covered organic growth, we've covered horizontal integration, and we've covered vertical integration. So these are three of the methodologies by which companies can grow. The next example I'm giving you is not an actual method for companies to get larger, but a method for companies to gain more customers and potentially to utilize some of these economies of scale or some of these advantages, but not by changing ownership or not by transferring equity. And so this one will be called corporate alliance. Corporate alliance is the collaboration between firms on projects without changing ownership. Okay, so one company's not buying another; they're just working together to accomplish a goal that is of shared benefit. So one, they can share customers, they can share resources, potentially operate in different geographies, they potentially operate with shared expertise. Right? They want to use what the other has without giving up equity. And the other group or the other company will want to use what they have without giving up their equity, so they can both benefit, right? So don't want to go so far as to share company. They want to share customers, resources, expertise to make sure they can accomplish a goal, right? So one example of this that I'm sure most of you have experienced is the Star Alliance. We're talking about airlines, right? If you fly in your plane and say you want to go somewhere around the world, right? And you jump on Air Canada. That Air Canada plane is not going to be the same plane that takes you to your final destination, right? Because Air Canada doesn't want to fly everywhere. It's a far too high of a cost, and it's not going to be profitable. And so they want to be part of the Star Alliance, where they will fly somewhere, and then you'll transfer planes to another flight on one of the other Star Alliance members, and so that the customer that starts and originates from Toronto will fly on Air Canada and then go to another airline. And so then you can share customers with other airlines, right? They're going to share their ability to operate in other countries, operate with without having to, have their own kiosk in every airport around the country, because it's not useful. It's not efficient to try to do that everywhere in the world, right? It's not going to be profitable enough. So that's one example of a corporate alliance. Another example that you might be more familiar with or will see is if you look at your Starbucks cups and you think about where did you buy your Starbucks, right? Starbucks has many standalone kiosks and standalone, I guess, coffee shops. But you'll also find that Starbucks goes or is in Barnes and Noble, is in Chapters, is in Target, is in Longo's. They have deals with PepsiCo, United Airlines, Apple. All these types of places, Starbucks has made alliances with some of these companies to operate in their places of business, right? And so why would this be good, right? Obviously, Starbucks is a huge draw, right? A huge draw for places, for example, like Chapters, right? Some people will go into the Chapters just to buy the Starbucks. And the other token is some people might go into Chapters for Chapters, but then have a Starbucks while they're there reading a magazine or whatnot, right? So creation of corporate alliance to share like-minded customers, or even to access customers where you normally wouldn't have been able to access them. And so this is the advantage of corporate alliance without sharing or giving up of equity. So if we look at and talk more about growing business from small business to large business, we want to talk about ultimately what is the largest business, the multinational corporation, right? So the multinational is the McDonald's, is the Starbucks, is the Coca-Cola, is the Toyota, all these companies that operate with global scale, with ability to influence perspectives, influence economies, even influence politics potentially, right? These firms are massive in scale and power, and so this is the multinational. And I'm not saying every person wants to become a multinational, but I'm saying that big businesses, when they get to this kind of pinnacle, when they get to this Amazon size, this Apple size, they are multinational corporations because they operate in multiple countries with multiple and global perspectives and power. Okay, so be very clear: multinational is not just a corporation that operates in multiple countries. That doesn't make you a multinational, right? A multinational is much more like a big, massive entity that has global influence and perspective. Like if I lived in Detroit, my brother lives in the States. If I live in Detroit, or he lives in Detroit, sorry, and I live in Windsor, we could both open up Shin's something store. We operate in two countries. We are connected, but we are not multinationals. That's ridiculous, right? So a multinational has a much larger scope and scale. They're able to exercise power where they operate because of their power and their scale, their employees, their impact on the economy. And so this is very important because Canada has historically been known or has been a branch plant economy. So when we look at Canada, we think about Canada's history. We're a relatively young country, and so we are a branch plant economy. As these corporations, you think about the auto industry, they come and they set up bases in Canada. What did they do? They created lots of jobs here. They created extensive economic activity. It was very good for this part of Canada, right? They had access to our factors of production. They had access to our customers. It created competition in our industry. However, there is no Canadian car company, so maybe it destroyed some competition perhaps that could have come out of Canada, who knows, by pushing out the local industry. And so why and how does it matter? Let's look at political influence, right? So if these multinationals go to your country, or as in Canada's sake, they go into Canada and they operate and they do things, what might happen, right? They are major influences on our economy. They impact employment. They impact GDP. But what if they want to do something that maybe does not fall in line with what Canada wants them to do, right? Canada demands them to operate a certain way, and they may say no. And so there's influence. There are factors that may push and pull against our government, toward this company, or that company toward our government. What if they pollute too much and Canada says stop it, and they say no? What's going to happen? We kick them out, and then we lose 20,000 jobs, right? So these are factors that relate to Canada historically. Nowadays, it's not so much of a big deal, but it still matters. I'm not sure if you remember when Amazon wanted to open up another head office. All these companies or all these countries and neighborhoods were bidding on this head office, right? So if we're bidding on it, what are we offering them to come to our country to make those jobs, to create economy, right? Are we offering them tax breaks, right? Why do corporations have huge tax breaks where individuals don't, right? There's political influence here that maybe not the common person doesn't understand when in terms of large, powerful companies. And so the next question I'm going to ask is why be a multinational, right? So the answer may be obvious. You're going to make more money, right? It's, however, very difficult, much more complex. But you have access to resources globally, across borders, right? You reduce risk. And so what do I mean by this? If you operate in multiple countries, you are not solely slave or influenced by the economy of one nation or one currency even, right? You're geographically diversified. Your risk is spread over many countries, right? You're financially a bit more stable with your currencies, right? You have income sources from many different places. The political stability of one country is going to be not too influential on you because you operate in multiple countries, right? And so all these things help you want to be a multinational, help you to achieve certain goals where otherwise you may not have been able to. And so I mentioned before, but it's very complex. It's much more difficult, I would say. And so that talks about decision making. So where does decision making come from? You have a multinational like, say, Coca-Cola, where their head office is in Atlanta. Does Atlanta make decisions for Coca-Cola in, say, South Korea? Right, so you have to think about that. Where are we going to operate? What are we going to do? How are we going to manage things? And so, I would say that in Atlanta, for Coca-Cola at least, they'll probably make very broad strategy decisions. Right, they'll make major financial decisions regarding how the overarching company will operate. However, locally, they probably don't have any idea what a local person in South Korea might want or care about, right? So a local branch office would make more localized decisions, right? With product pricing and marketing, what's available there, what they choose to do there, right? Even if you think about like McDonald's, right? McDonald's has different product offers in different countries. If you think about Coca-Cola in Canada, like I think Cherry Coke might exist more now, but Cherry Coke has never had a foothold that much in Canada, right? But Cherry Coke is in the States a lot, right? So you need to understand that multinationals have a very layered, complex decision-making process, which is understandable because these are massive companies that have massive choices to make. So the original question we talked about was, what's the difference between getting small businesses and large businesses, going from small to large, using horizontal integration, vertical integration, organic growth, ultimately becoming a multinational corporation, right? So how do we get there, right? I mentioned how organic growth is very difficult and time consuming. It takes you time to grow companies, right? We looked at those mergers, Amazon bought Whole Foods for billions of dollars. How long is it going to take you to make billions of dollars organically, right? So yes, you can use organic growth and corporate profits to grow, but it's much more likely that you'll borrow money, right? You'll borrow from a bank or an individual to grow and ultimately try to pay it back, or you'll sell equity in your companies, which the example I gave on Dragon's Den, that's often what the case is, right? They'll say, we want $500,000 and you can have 25% of our company, right? So they'll sell parts of their company to these people for their money. And so we want to examine this borrowing business versus this selling equity business. Why would we choose one or the other? So it's important to understand what each of them mean. And so bonds. Bonds is the first scenario, and bonds are a promise to repay with interest at a predetermined date and rate. And so a bond is going to have pieces to it. One is the principal amount, which is the original amount. Like say you borrowed $1,000 or you borrowed $1 million or $1 billion. That's the original amount. The interest rate, compounded annually, probably not, probably compounded daily, monthly, whatever it may be. You may be charged an amount of interest on that principal, right? So if you borrowed $1,000, they may charge you 5% interest, right? And so you have to pay off 5% per depending on how much is compounded, but 5% would be the yearly rate, but you'd compound that every month or whatnot, right? So that's the interest rate on the principal. And then there's the term. How long are you borrowing the money for? And that tells you when do you have to pay back the principal plus the interest, right? So maybe it's a $1,000 bond for 5 years' time, right? So that's the borrowing bonds. An important factor to note is that bonds is not ownership. Bonds is borrowing money, right? We're looking at term, length of time, due date. Right? I'm not giving you ownership of this company if I'm paying you money back, right? So I'm paying back the money with interest, and the interest is the price, right? The price of this loan, the price of this bond is the interest. And so I'm paying that back. And so I'm not giving you my company, I'm just borrowing money from you. And so let's look at a bond. This is an old school bond. If you buy bonds these days, you will probably never see one of these documents. Some of you might have bonds that your parents may have bought from you when you were younger, and you might have some certificates. But the reality is most of this is electronic. But bonds all have a certain characteristics. And so here, let's look at this example. The principal amount here on this bond is $1,000. This is for McDonald's Corporation. So McDonald's will write the bond, they'll issue the bond, and someone's going to buy the bond for $1,000. Okay, so they're going to give McDonald's $1,000, and McDonald's says, I'm going to pay you back that $1,000 plus interest, 4.25% interest. Okay, and it's due in 1993. So depending on when this thing was issued, maybe it was issued in 88, so maybe it was a 5-year bond. So it's due 1993, interest rate's 4.25%, and the principal amount is $1,000. And so that would be an example of a McDonald's Corporation bond. Bonds come from corporations, bonds come from banks, bonds come from governments. They're all basically loans. Okay? So the next form of raising of capital or money is the shares or stocks conversation. So with shares and stocks, we're looking at selling or buying shares to own or sell part of a company. Right, so the bond was a borrowing, bond was loan, bond was to be paid back, and shares and stocks is to own a piece of company. So, for example, Toys R Us, well, they went bankrupt in the United States, but they still exist here. But they were owned privately by Kohlberg, Kravis, Roberts, Bain Capital, and Vornado Realty. So they own this corporation privately, right? It's not a private company in terms of a sole proprietorship, but it's a private corporation. And so these groups or these companies owned Toys R Us. Okay. Another example would be Facebook. Now is a public corporation. Okay. They sell stocks on the stock exchange. Their ticker is FB, and they are a public corporation where any of us can buy and sell shares in Facebook if we want to. And so there's private corporations where all shares and equity is held privately, and there's public corporations where all shares are held publicly. And so that's the two different versions of shares and stocks for corporations, private and public. And so I'm going to give you an example of another stock certificate. And so this is a stock certificate for Google. Again, if you buy shares, you're probably not going to get one of these, but I guarantee you these exist and people have them. And so here's our ticker for Google, which is now called Alphabet, GOOG. This is for one share. And just to show you, this is Larry Page and Sergey Brin, who are the founders of Google. And so you can buy shares, you can buy bonds, you can sell shares, you can sell bonds, depending on what you're trying to do. And so we're going to examine a little bit about why would you want to do one versus the other. And so you would want to do bonds if you don't want to sell equity in your company and you're confident in the ability to repay. Okay? But you have to repay. And so money and income from your company needs to go to repayment of debt. Whereas in shares and stocks talk about you're selling a piece of your company, so you're willing to get less equity. And so as this company grows, you own less of it for the growth, but you don't have to pay the money back. Someone's buying into the company, therefore they're investing into the company the same way you would invest your own money into your own company. So hopefully that's a decent amount of information on shares and stocks and why you might want to choose shares and stocks over bonds or the other way around. And so we're going to continue going on with some more conversation about some terminology of stocks and shares. So here is an asset value, here is book value, and here is market value. And so I'll show you them all at the same time. And so let's work backwards a little bit. Market value of a share is the market price of the share, right? How much is this current share worth in this moment in time? So right now, if I look at an example of market value, if you look at Google, and so this is the chart for Google stock, and so maybe I'll put it to 5 days, you'll see that right now Google is worth $1,560 US. And so that's the price of one share of Google. Okay, that's the market price. And so right here, the market value of a share, the price at any share at any point in time. This morning, Google opened at $1,583.78. It's gone down a little bit. A month ago, it was worth $1,431.16. And this is the chart of Google, okay, from its inception a long time ago in 2004. And so if you look at market value, that's what it's worth currently. If you look at book value, that's the value that the share was originally priced. And so let's go back to that chart and let's look at this chart. And so the book value of Google, it says here roughly, depending on how accurate this chart is, this graph is, $54.15. And I will say that that is actually very accurate because I do know that Google's book value was not that. So when I say that it wasn't $54.15 like it says here, I know because I was working in finance at that time, and I knew that the book value of this IPO, this initial public offering, was $108. And so I remember this distinctly, and this means that the stock is split. And so half of 108 would be the 54, and so this stock has split once since that time. And so now instead of one stock at 108, it's equivalent of two stocks at 54. And so the book value of Google is actually $108, as was their value when they released their first amount of shares. The next one is asset value. Asset value is the shares portion of the company's net worth. And so what are we talking about here? We're talking about if the company Google were to sell off everything they own, all of their assets, all their technology, all their space, all of their everything, and they used all that money to pay off all of their debt. So every portion of debt, that any money they owe anyone or any company or any government, they paid everything off. There's going to be a huge pile of cash sitting there at the end. Okay, that asset or that cash, if you divide that cash up amongst every single one of its shareholders, that is the asset value of one share. One share's portion of the company's net worth. And net worth is assets minus liabilities, all the stuff that they own of value, take away all their debts that they have. And so that is asset value. And so let's look at more about the industry of the stock market or the shares. If we look at the stock market, we want to look at where shares are sold. We want to look at the stock exchange, the actual buildings of where shares are sold. We look at a stockbroker, the agent for transactions. And so if we look at these three pieces of terminology, which is very important to understand what each of these people are or what each of these places are. And so if you think about a stockbroker, you might call someone on the phone and tell someone to do a trade for you. That would be a stockbroker. So they do the transactions for you unless you're doing it on your own on the online or wherever. And so that will take us to our next comment, the stock market versus the stock exchange. And so most of you probably can picture the stock exchange, like the New York Stock Exchange, where you see people yelling with pieces of paper in their hand with lots of those computer screens and those TVs. That's the stock exchange, where you hear someone ringing the bell to open the exchange. That's the actual building, right? If you think of any movies where this happens, okay? Stock exchanges don't really actually need to physically exist anymore. We don't need the buildings because we have stock markets. It's where things are actually sold and transacted. If you think about the NASDAQ stock exchange, it's actually an online building. So most of these, not online building, an online marketplace, right? So most stocks are sold online because buildings don't actually need to exist anymore for the gathering of people to do these exchanges. Technology has made it possible where everything can be done just online, and so the stock market is just where these shares are sold and bought, and there are many, many places online to do it. So to continue on our conversation with securities, we want to look at a few different types of securities. And so the first is mutual funds. You might hear a lot about them, or you might know a little bit about them. And so let's see what they are. A mutual fund is a fund comprising of the investment of many clients in many companies managed by professionals. And so let's look at this first example. I'm going to show you a conceptual version of it, and then I'll show you a real version of it. And so the first example, a fund is like a pizza, okay? I took this image from an Instagram site. And so imagine if someone makes this pizza, okay? And this pizza has many, many toppings on it. So you can see UPS, you can see General Electric, you can see Shell, you can see Salesforce, you can see Microsoft, all these different companies, right? And so each slice of a pizza has a bit of every company. Okay, and so someone manages this pizza, someone makes this pizza, someone designs this pizza, and what are you doing? As an investor in a mutual fund, you are buying a slice of the pizza. So you buy this individual slice, and that individual slice has a little bit of Shell, has a little bit of UPS, a little bit of GE, a little bit of Salesforce, a little bit of each one of these pieces of pizza. You don't have a whole share of Shell, a whole share of anything really. You just have a piece. Okay, so every person who wants to buy into this fund buys a piece or a slice of this pizza. Okay, on that slice you get a piece of all the toppings. The toppings are the stocks, and you're just buying a single slice, but you own a bit of all the toppings. Okay, the fund manager who makes this pizza decides which toppings will go on the pizza, or which stocks make the most sense for this type of pizza, right? And so each slice is going to be influenced by the returns of each of the different shares or each of the different commodities, whatever they happen to be buying. And so that's how a mutual fund works. You're paying someone to make this recipe. And why is that? Because you want to diversify, okay? If you have enough money, right? So lots of people don't have enough money to buy each one of these shares individually, and so they want to buy into a mutual fund to buy up these shares. And that's just how mutual funds work. We can talk more about, do I agree with mutual funds, or do I think they're smart investments? Ultimately, you're paying someone else to manage this, and so you're paying away some of your returns, even if they make money or not. And so that's a conversation that we'll go over a little bit later. So that's just the conceptual example. And so I'm going to show you a real example of a fund now. And so here is the RBC Canadian Equity Fund. And so most funds have I guess a mandate or a style, right? So this fund is the RBC Canadian Equity Fund. So they're investing in Canadian equities, okay? And so you'll see here, this fund has Royal Bank of Canada, TD, Suncor, Bank of Nova Scotia, Canadian Natural Resources. So this fund owns all of these things, okay? And so all these stocks are like the toppings, right? All these stocks are like the toppings. And so they could be corporations, they can be equities, Canadian. So you can see here lots of them is cash, Canadian equity, U.S. equity, international equity, and so all these types of things, right? And so as these stocks and stuff perform, the entire fund is going to perform, right? And so you'll take a look here. You can see the distributions, you can see the profits, you can see how much it's been going up or down. You can also see who manages this fund. And so these people manage this fund, and this fund has a certain value, and they get paid based on that, right? And so, again, do I believe you should invest in them? Some people need to, some people don't. Again, how good are these people going to do versus the rest of the market? Again, it's all up for debate. But that's how mutual funds work. You're buying a piece of this pizza, which is managed by other people, and these toppings are different types of equities. So the next thing is commodities market. What are commodities? Commodities are standardized raw or semi-processed goods. Think about like wheat or gold or oil. Things that are more like natural resources, they're raw and semi-processed. So that's the commodity. They're actual things. They're not stocks or equities in companies. Okay, and so the spot market and the futures market deal with commodities specifically. Okay, and so the spot market talks about, I want to buy this commodity right now for delivery today. Okay, so I want to buy this barrel of oil because I want it now. Okay, that's you're paying transacting immediately. The futures market is a little bit different. The futures market talks about where you're buying something, or you're agreeing to buy something at some future point in time, maybe a year from now. So you as the buyer and them as the seller, you agree today on a price for a future date. And so a year from now, you might agree, I'm going to pay you X amount of dollars for this much stuff. Okay? And a year from now, the price of that thing could have gone up already, so that would be great for you. Or the price of that thing could have gone down, which is not good for you. But regardless, you've already agreed, so you pay and they deliver. Okay? There are several reasons why you might want to do this. One is just investing. You're just making gambles. You're predicting that this thing is going to go up in value, so you buy some futures today. That's possible, right? The other possibility is that you are an actual producer, right? You want a commodity because you need it as part of your factors of production. And so you'll agree on a price today for the future because you know you need that thing in the future. And so part of your factor of production, you want to lock in a price. You want to make sure that you're going to get this thing at this price in the future to ensure that you get delivery of product, that you can deliver your other products on time as well. Okay, so some of it's about hedging bets, some of it's just about betting in general. So that is the spot and futures market regarding commodities. The next two concepts are fairly difficult, and so we're going to go over them. I'm going to take some more time in class to do them. I'm also going to point you towards a video to watch to make sure you know what's going on. So we have call options and put options. And so we want to ensure we understand that call options and put options are directly related to stocks/shares. Okay, public stocks/shares. You are making bets on securities like Google. You're making bets on stocks like Amazon, Facebook, all these kinds of things. And so what is a call option? A call option is the right to buy an investment at a future date at a specific price with a maturity date, while the put option is the right to sell an investment at a future date at a specific price with a maturity date. So let's identify the key factors. Call option is the right to buy, put option is the right to sell. So this is the right to buy an investment. This is the right to sell an investment. Okay? The option is the actual right. The option here is the right to do this action. Okay? Another factor is it's time constrained. This option only lasts for a certain amount of time. Okay? This option also lasts for a specific amount of time. So I have the right to sell something within this time before the expiry date, before the maturity date. Okay? And this right to buy this investment is at a specific price. Could be $10, could be $100, could be $1,000. Okay? So I have the right to buy a stock before a future date at a specific price. Okay? So, a call option would be based on a share like Google, for example. Okay? So, for example, Google right now, again, it's selling at $1,552.60. And so my call option would be the right to buy Google, or Alphabet, I should say, Alphabet, at a specific price that's not the market price. It's going to be a price that's listed on this option. So I'm allowed to buy this stock at a specific price before a specific date. And so, if my option said $1,600, would I do it? Of course I wouldn't do it, because I would just buy Alphabet in the open market. But if my option said buy Google at $1,500, I would probably do it, because that means I can sell it right away and get $1,554, right? So the option you make the agreement, and the option will sell us, say, a specific value with a specific maturity date. Okay, and so I want you to watch the video for more clarity if you're not in class right now, as I'll explain it with much more depth in class. It's very difficult online. So take a look at the video, ask me questions to make sure you understand what's going on. All right, that's the lesson for today. Thank you.